Hello everyone, how's it going? In this video, we're going to be talking about MMTLP. So basically, over the past few weeks, a lot of people have been gathering around this stock. Some of us have been holding this company's shares for far longer, and a lot of us have also been burned by previous short plays. Personally, I have participated in Progenity, for those of you who can remember, and I still have those shares, and they are down by, I think, something like 80 to 90%. So yeah, I completely get like the excitement around the idea of short squeezes, but also we need to like appreciate the risks that come along. I'm sure that a lot of us by now, we are fully appreciated of like what kind of game we're playing here. So with all that being said, today we're going to be talking about how MMTLP fared in like the latest trading session, what are going to be some of the scenarios going forward, and if you should be buying the stock at the current stage. So before I go forward, if you appreciate my videos, please consider to drop a like, subscribe to my channel, and also check out the links down in the description. So every single support will be greatly appreciated, and I will dedicate like more energy and to research and to prepare the videos and to hopefully make more videos as well, because there are so many great stocks that we can and should cover. So with all that being said, let's get into today's topic, MMTLP. So MMTLP is basically a spin-off from MMAT, and they have been talking about like potential merger and S1 approvals, at the end of which the stock will go private. And the main selling point here is that there is a high amount of short positions that are been accumulated on the top of the stock, because, well, institutional players might not be interested in holding it for the long term. And a lot of people were saying, well, you know what, this is a small cap, it's not serious. Let's try to make a buck by squeezing the stock price down. So the way that short selling works is that people borrow the shares from brokers and then they sell it, then they will buy it back later. It's basically like a loan of shares with which they have to pay interest for, and the interest would be paid in the form of financial fees as long as those positions remain open. This is why the longer it drags on for short sellers, the less money they're going to be making, and also the higher the stock price goes, the more losses they're going to have. And the difference between going long or going short is that going long, the gain is potentially infinite. The loss is between the price level whenever you bought it and zero. Whereas for the short selling is the opposite. The profit is like from wherever the stock price is when they first dumped it in the market and zero. So that's like their gain potential. And the loss is theoretically between whenever they first shorted it and infinite. So this is why the higher it goes, the more spooked those short sellers are going to be, and they might be compelled to liquidate their positions. In other words, they would buy back the shares at the open outcry and will give it back to the brokers. This would act as a second push for the stock price upward. And we have seen it work with two obvious examples. The first one is AMC, the second one is GameStop. So fundamentally, can we really say that those two companies are in the best shape to face the future? I don't think so. I mean, one operates cinema, the other one sells video games in a brick and mortar store. But here's the thing, it doesn't really matter what the fundamentals suggest, right? So if we invest based on the fundamentals, a lot of those short selling plays, the short squeeze plays, are not necessarily attractive. But if we go in on the basis that a lot of people will pile in and they will force the short sellers to sell, and in this case, there's also like the element of once the approval goes through, then the short sellers have to redeem, and then MMTLP share price will go through the roof. So that's like, in my opinion, what people are expecting things to be. Now, with that being said, can we necessarily say that this is going to happen for sure? Well, nothing is for certain. And even though things look mathematically plausible or even likely, there can still be like a whole bunch of reasons that might explain why the stock will not take on the route that we all believe that it's going to take. Okay, so when we play like the short squeeze game, we really have to prepare for this kind of scenario by saying it's possible that the stock doesn't go my way, and even if it doesn't go my way, it's okay. Like, it's okay that it doesn't. And I have enough eggs in different baskets that it ultimately doesn't really matter. It doesn't have to matter, and it shouldn't matter for the sake of your overall portfolio. Because here's what's going to happen if you go heavy in MMTLP. I mean, I used to trade Forex before, and I used to trade like at the maximum leverage. I think on my platform it was something like 50 to 1, meaning 50x leverage. And I used to only have like 1 or 2 positions. I remember how like poorly I slept every single day because I want to check how like where the stock price has gone to. Sorry, not the stock price, but like the currency pair exchange rate has gone to. And they really, tickle my nerves every single pip that moves up or down. And in that case, I may lose money with every single price movement because I have short and long positions at the same time, right? So this is why I also have learned that it's very important to be careful about the short place, about short selling, because it may sound cool. You may, feel like you're George Soros or something and make money when everybody else is losing theirs. But at the end of the day, these are just educated guesses that we have about the market. So MMTLP has on paper a lot of the stars that are being aligned. Like, it will have a great deal of potentials in the future. The energy price is high. But why is the stock price relatively down today? And also, what's going on with the shorts? Like, why are they not covering? Well, in my opinion, they're not covering because they don't think that now is the time. And maybe also because they may not care enough to redeem their positions. Like, for some of those firms, even if they eat up the losses, it's going to be fine. Like, it was factored in how much they're willing to risk to begin with. I remember in the beginning, a lot of people were saying, the short squeezes, like the OG short squeezes, AMC and GameStop, that they're going to hurt funds like Citadel. Well, you know what? It didn't really hurt Citadel because they're far too large to be damaged by this kind of positions. On the other hand, some smaller funds that were very heavy on shorts were greatly affected. I'm thinking of a fund called, I think, Melvin. I think it was Melvin that was greatly affected by the short squeezes. The other examples might include Archegos. So Archegos is involved in a like financial fraud. Essentially, they were using synthetic products to increase their leverage, and in the end, it didn't really work, and the fund was liquidated, and it got involved with multiple banks that lent money or lent funds to it, and got badly burned as well. I think Credit Suisse was one of them, and the other one was Nomura. Now, the reason why I knew about it was because I was covering Fubo TV at the time, and Fubo just got like a huge dump one day because the size that Archegos was taking into those stocks. To be honest, I wouldn't recommend putting a lot of money into a company like Fubo, and yet some funds, institutions decided to do this. So this is why, on one hand, the blindness in front of like exposures and risks is common to both institutional buyers and retail buyers. Okay, so it's not because they're an institution that they're a fund that they're gonna necessarily be more vigilant. It doesn't always happen. And if we recall, like way back in pre-08, pre-07, pre-08, Deutsche Bank had a huge amount of derivative products that they still to this day they are carrying on their balance sheet, and this has plumbed the share price of Deutsche Bank, one of the largest commercial banks and investment bank in Europe, to this day. And a lot of people were worried that they're going to go under because of it. So my point is, we really have to control how much we're buying and selling when we deal with companies like those. So as far as MMTLP is concerned, I mean, should you trust that there is a short squeeze that's going to happen? I think so. I personally believe that it's plausible and likely that this scenario will be the one that we're going to see in not so long. Okay, so that's number one. Number two, should you be buying it now? I mean, this is a little bit harder, but I think that you should have a certain presence in the market for sure. So I would recommend to maybe like buy the shares, buy enough shares so that you no longer have FOMO. If the stock takes takes off to like $25 tomorrow morning, you're not going to regret for not buying more. Okay. On the other hand, I would suggest to reserve at least 50% of your allocated amount in case the stock goes into a retracement or a pullback, which is likely. I mean, it just made new highs. So why would it not take a pause and to like start regrouping once again? So with all these elements, I would say that yes, it's a stock worth buying. It's a short-term volatility play, or it's to the very least, it's a trade. Whether you want to invest into MMTLP in the future, that's not really within my purview. But let's just say that with the energy price at where it is, it's going to be an interesting stock to hold for sure. But we also have to think about the aftermath. We gotta remember that oil price hasn't always been that high. And once the conflict ends, what's gonna happen with, all of these, okay? Even if the sanctions will remain after the end of the hostilities, is it really going to continue to be like one of the main elements that's going to hold the energy price that high? We don't know about it, and I would rather not put too many eggs into this scenario. So regarding the investment, go for it if you believe into the long-term future. I see that there's a lot of optimism online about it. It doesn't necessarily mean that people are always aware of the risks involved. Okay, that's just in the human nature. And I would include myself into it. But with that being said, definitely keep a portion of your allocation aside. And if there's any pullbacks, then gradually, add the position in. I would say that it would be acceptable to buy your position over the course of like 2 to 3 weeks. And then we shall see if the S1 approval passes and then what's going to happen by it. Okay. So yes, my recommendation is to buy MMTLP. Yes, I do recommend to buy it now. And I would suggest you to be mindful about the exposure that you're going to take and to leave an allocation in case there's any pullbacks. So the maximum exposure I would recommend is around 1%. Now, previously I've said that, maybe control it between 0.5 and 1. If you want, you can crank it up to 3. But the 3 would be like the allocation for over the next few weeks and even month. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.